Hello friends, I'm Narendra Verma. As you know very well that we are running a series on chapter 2 in accountancy for class 12 CBSE syllabus, and that chapter is fundamentals of partnership. And till now we have taken 2 sessions. Okay, so this is the third session. What we are going to cover in today's session, let's have a look. Difference between LLP and partnership, means limited liability partnership and general partnership. Profit and loss appropriation account, what does it mean? Features of profit and loss appropriation account, and difference between profit and loss account and profit and loss appropriation account. All right, so without wasting much time, let's start. Okay, very first let's talk about LLP, means limited liability partnership. Already you people must have learned about it in 11th standard, but even then I'm introducing it once again. Okay, this is a kind of middle position between partnership and company. When you are going to study about LLP, then compare it with company. It is more or less like company. Okay, there are various differences as well. So the biggest difference about LLP and general partnership is what? The act. Okay, on general partnership, Indian Partnership Act 1932 is applicable, and on limited liability partnership, LLP Act 2008 is applicable. This is one difference. Another difference is what? As the name is limited liability, we know very well that in partnership the liability of every partner is unlimited. All right, so but in company, liability of every member is limited up to the amount given to the company. All right, similar condition is applied here. Here the liability of members is limited to the contribution given by them to the firm. Okay, if the liabilities increase, means say for example there are 3 partners in LLP. Okay, and one partner A has invested 20,000. Say for example the losses have exceeded 20,000, so he need not pay anything else after that. Okay, but in general partnership it's not like that. Every member has to bear the losses in the same proportion as they bear the profit. Okay, so this is one more big difference. Understood? Okay, so this limited liability partnership is there just to give a kind of company form to partnership. Okay, and it is having some modified features. It has some features of partnership as well as some features of company. You cannot call it complete general partnership or complete company. That is why the name has been given LLP. All right, okay, so now let's compare LLP and general partnership. Two differences already I have shared. One, in general partnership, which act is applied? 1932, Indian Partnership Act 1932, and in LLP, Limited Liability Partnership Act 2008 is applicable. One difference. Another difference, that under LLP, the liability of all the partners is limited to the contribution given by them, except one partner. One partner is having unlimited liability in that, and rest of the partner will be having limited liability. That's what the feature. Okay, now let's talk about general partnership. In general partnership, we already know that every member, every partner is having the unlimited liability. Okay, now another point of difference, that in LLP what happens, the corporation is must, means as the company is formed legally and it is closed also legally. Okay, on the basis of legal procedure it comes into existence, means every company has to get itself registered under registrar. All right, similarly every LLP has to be registered under registrar. Okay, but in case of partnership, already we have learned, partnership means general partnership, we have already learned about it, that registration is not mandatory, not compulsory, not essential, it is voluntary. If it is done, it is okay, otherwise there is no problem at all. All right, okay, so this is again one difference. One more difference is that in LLP, what happens? LLP is bound to show their financial statements on their website to the public, like company does. But for a partnership firm, that is not a kind of binding. If they desire to do so, they can do. Otherwise, there is no legal binding on them. Understood? According to Indian Partnership Act 1932, they are not bound to disclose their financial statement on their websites. Maybe possible, so many of them are not having even the website, but for them it is must. They have to disclose their financial statements to the public. Okay, this is again a big difference. Okay, now let's have some more points about it. We learned in case of company that company has a separate legal entity. Okay, so LLP also has separate legal entity, but our general partnership does not have separate legal entity. Understood the point? Okay, our general partnership firm is not separate from, when we say separate legal entity means legally we're talking about, the legal word is added there, and already we have learned that partnership is not having separate legal identity. Means if we see from legal point of view, firm and partners both are same. Okay, and LLP is a corporate body. Okay, and general partnership is not a corporate body. One more point is that in LLP, partners are not jointly liable for the act of other partners. Okay, but the function that the feature we discuss, mutual agency. So that mutual agency feature is not available in LLP, but it is available in our partnership. All the partners are legally bound. All right. Okay, legally bound for the act of other partners. But in case of LLP, it does not happen. So we need to keep this thing also in mind. Okay. I hope we have covered all the points here. You can see all the points on your screen right now. Now let's move on to another topic of today's session, that is profit and loss appropriation account. See, you already know the meaning of profit and loss. Now you need to understand the meaning of this new term, which is known as appropriation. Okay, you need to understand the meaning of this, otherwise it is going to trouble you a lot. All right, appropriation means distribution, nothing else. It means distribution. Okay, and distribution of what? Distribution of profit. This is the only reason why it is prepared. Already I have told you, like sole proprietorship, under partnership firm also trading account is prepared, and then profit and loss account is prepared. Okay, and balance sheet is also prepared. But one thing is additionally prepared, that is profit and loss appropriation account. Why it is prepared? Imagine, in case of sole proprietorship, what you used to do? After calculating the balance of profit and loss, if it is net profit, then what you are doing? You are adding that net profit to capital. And the capital represents whom? Owner. And the owner was single person. Okay. But here, if we do so, if we try to add net profit directly to the capital, now the question arises, to whose capital? To A's capital, to B's capital, to C's capital. All right. Now you would say, sir, say for example that we have net profit 20,000. So that 20,000 should be distributed in their profit sharing ratio, and accordingly it has to be added to their capital. Yes, it is done. But before that, okay, out of these net profits, some distribution is done, which cannot happen in profit and loss account. Okay, so we need to understand what are these distributions. Okay, because only for these this account is prepared. This is right, that you are getting very much correct, that net profit has to be distributed among the partners in their profit sharing ratio, and thereafter their share will be added to their capital individually. Okay, but before going to that step, some distribution of profit is must. Some items need to be deducted before that. So what are those items? Very first we need to understand those. Only then we can understand why this account is prepared. Okay, but in short I can say this account is made up only for appropriation. Okay, appropriation of expenses related to partners, appropriation of all the amount being credited to partners. Okay, so we need to understand what are these. Very first we understand one thing, like profit and loss is added before this account, so we understand this is the extension of profit and loss account, because here also we do the treatment in the same manner, but the items are a bit different. Okay, the items which are there in profit and loss account, these will remain to profit and loss account only. Here you will have different item, but the treatment will happen in the same manner. The expenses will be debited and the incomes will be credited. Okay, now so this is the extension of profit and loss account. Okay, and what happens in this, I was talking about the item, I just note it down here so that you can understand in better way. So let's have a look. Items like net profit, because before that we have prepared profit and loss account and we have got net profit from there. Okay, so net profit and interest on drawing, because interest on drawing is the income for the firm. Okay, when the partners withdraw some amount of money, then they are supposed to pay interest on that amount to firm, so that is the income for the firm. Okay, so net profit plus interest on drawings. Okay, so these two things are added, and how many items are deducted? Very first, interest on partners capital, because this is the kind of expenditure for firm. Okay, but this is done only when the profit is available. I will just explain you. Okay, so interest on partners capital. Interest on partners capital is a kind of expenditure. Why? Because the firm has to pay it to partners individually. All right, and then salaries, commission, bonus to partners, that is also the expenditure. Okay, now transfer to reserve. If they want to maintain reserve, if they want to keep some portion of profit for future references for emergency purpose, then they transfer some portion of the profit to reserve. So these items are deducted. Okay, these are added, these are deducted, and then whatever portion is left of profit is distributed among the partners in their profit sharing ratio. When I show you the format of profit and loss appropriation account, then you will understand in better way. Understood? Okay, now you may ask one question, sir, why can't we deduct these items from profit and loss account? Because these items are not charged against profit. Okay, I explain you. These items will be deducted only in the case when this is present. Okay, if net profit is left, only then interest on partners capital, salaries, commission, and transfer to reserve, these things come into existence. Okay, but if the firm is incurring loss, means net loss. So in case of net loss, no profit and loss appropriation account is prepared. Understood the point? Now, what will happen? Net loss will directly be distributed from profit and loss account. Okay, we need not prepare profit and loss appropriation account for that, because appropriation means distribution of profit exists only when the profit exists. All right, when there is no profit, loss is there, so loss cannot be appropriated, cannot be distributed. Loss is only shared, and that can happen directly in profit and loss account, and these items cannot be deducted from there. Okay, because these are the appropriations of profit, not charge against profit. All right, we need to remember these two terms, charge against profit and appropriation of profit. So interest on partners capital, salaries, commission, bonus to partners, transfer to reserve. Okay, these three items are appropriation of profit, not charge against profit. All right, but we learned one more item, interest on loan, that is charge against profit. That is why I have not mentioned interest on loan here. Interest on loan will be treated as if the firm took loan from any other third party. If the partner gives, even then the same treatment is done. The interest on loan is directly deducted from profit and loss account, because that is charge against profit. It means even in the case of loss, the firm has to pay that money. That is charge against profit. And appropriation means in case of loss, the point of distribution does not arise for these. Understood the point? Okay, now let's move on. Okay, so now we have understood what is the meaning of profit and loss account and why it is prepared. Okay, so it is made only for profit. When there is no profit, then no appropriation account will be prepared. Now let's move on. What are the features of profit and loss account? The very first feature, it is an extension of profit and loss account. After profit and loss account, we prepare it and we can take like that, we extend the profit and loss account. So that is why it is known as extension of profit and loss account. Okay, and it shows appropriation of net profit. All right, so the another feature is what? It shows appropriation of net profit. Now another point, prepared only by partnership firm, right? Even in case of company, it is not prepared. It used to be prepared earlier in the case of Companies Act 1956, but now it has changed. Now Companies Act 2013 is going on, and according to that, no profit and loss appropriation account is prepared. So at present, it is prepared only by partnership firm, right? Okay, now the last point, entries are passed as per partnership deed or Indian Partnership Act 1932. Alright, earlier we were talking about interest on capital. If in partnership deed the clause of interest on capital is mentioned and rate is also mentioned, up to at what rate the interest on capital will be given, okay, then only the entry of profit and loss account will exist over here. If there is no point, then no entry will be there. Similarly, if the salary point is given, then salary entry will come here. Likewise, interest on drawing clause is given, then interest on loan entry will come here. Understood? So the entries are passed as per partnership deed and Indian Partnership Act. Okay, wherever the deed is not applicable, then Partnership Act is applicable. So these four are features of these profit and loss appropriation account. It is extension of profit and loss account, shows appropriation of net profit to various accounts, prepared only by partnership firm, entries are passed as per partnership deed or Indian Partnership Act 1932. All right. Now let's understand in detail how does it differ from profit and loss account. Means what are the differences, what are the points of difference between profit and loss account and profit and loss appropriation account. See, if you want to know the point of differences, the very first point is it is prepared after trading account, okay, and it is prepared after profit and loss account, right? Very nominal difference. Now another point of difference is what? It is prepared by sole proprietorship and partnership firm, okay, and it is prepared only by partnership firm. Already we know that. Okay, now expenses are debited and treated as charge against profit, and here expenses are debited and treated appropriation of profit. So here the expenses are treated as charge against profit, and here the expenses are treated as appropriation of profit. And one more point we can keep, it is prepared to know net profit or net loss, okay, and it is prepared to know distributable profits to partners. All right, so it is prepared to know whether the firm incurred net profit or net loss, and it is prepared to know how much amount, how much portion of profit will be given to the partners. All right, so these are the 4 point of differences you can see on your screen as well in proper way. Okay, so this is all for today's session. I'll be meeting you in the another session very soon. Till then, bye bye.